If you ever open up an options chain and thought, what am I even looking at? This video is going to clear it up for you. I'm Peter Penn from Penn Corp Consulting. I have 15 years experience in the market as well as brokerage training. And my job is simple, to help you understand your options. Yes, pun intended. This is part of my Moomoo options education series. So I'll be using Moomoo for all my demos, but regardless, the concepts apply no matter what brokerage or platform you use. I split the videos into chapters, so feel free to jump to what you need or come back and review. All right, let's get into it. Understanding option contracts, a buyer's guide. Before we get into it, disclaimer, this material is for educational and informational purposes only. I'm just a guy on the internet. What you're going to learn in this video, what is an option, what you can and cannot do as a buyer, how to read an option quote such as strike price, expiration date, as well as contract size, American versus European options. What does that even mean? How the moneyness works and how price splits into real versus time value. Some quick math for break even and simple profit and loss on long calls and long puts. Very high level of the main Greeks you see on really any option trading platform, and why the prices could change daily based on these parameters. So what is an option contract? Well, an option contract is a derivative giving you, the holder, the right, but not the obligation to buy or sell an underlying asset at a predetermined price known as the strike price on or before the expiration date of your option contract. There's two types of options. You have call options and put options. A call option gives you the right to buy the underlying security at the strike price by the expiration date, and you have to pay a premium. For put option, that gives you the right to sell the underlying asset at the strike price by the expiration date, and you have to pay a premium as well, right? We're buying options. In regards to option risk level and approvals, this is a pretty standard practice across the industry, and brokers typically categorize in 4 different risk levels. A level 1 option trading approval would be something like buying calls or puts. A level 2 option trading approval would be something like covered calls. So you own stock and you write calls against it, right? Covered calls, also known as a buy right. A level 3 option trading approval would cover spreads. So your debit and credit spreads. Example, maybe a bull or bear call spread or bull or bear put spread. These are also known as vertical spreads. And then a level 4 option trading approval, which would be the highest risk, would be something like a uncovered or naked position, right? Such as maybe say selling naked puts or selling a naked call. And always just double check with your broker to see what your option trading approval is. And if you are looking to trade any of these types of strategies based on the risk, just double check with your broker to see what the requirements are, as they do vary from broker to broker. Option exercise styles. So you have American style options and European style options. American style options are common on most equity and ETF options. In terms of the exercise timing, with American style options, you can exercise them at any time up until the expiration date. Settlement. So if you exercise your options, they will usually be physically settled or delivered, which just means that If you're long a call option, you exercise your call option. Well, you're buying 100 shares of the online at your strike price, right? We all know that one contract represents 100 shares. If you didn't, you do now. For European style options, these are common for many index options. In terms of exercise timing, there's no early exercise. These options can only be exercised on the expiration date. And in terms of settlement, these are often cash settled. And I love cash settlement because it keeps the math very simple. It's always, let's say, if you're long a call option on an index, maybe the S&P 500 index, aka SPX, the difference would just be your strike price and settlement price. If you're making money, it just settles for the difference in cash, which is it's very easy. Love it. When looking on an option chain, you have standard options listed. However, there could be something known as a non-standard options or adjusted options simultaneously listed. And what's the difference? Well, standard option contracts that are listed represents 100 shares, right, per contract. And this is also known as a multiplier, right? So the premium that's being quoted, we want to multiply by 100 times the number of contracts to give us our costs, excluding commission and any transaction costs. The deliverables are always shares. If you look at a non-standard or adjusted option that could be listed simultaneously as well, these typically occur after some type of corporate action, and one or more terms may be changed. Symbol, multiplier, strike price, deliverable, or even expiration date, to name a few. So always, always, always double, triple check OCC for the US and CDCC for Canadian adjusted options. Expiration dates, lots to choose from. You have your daily expirations, also known as 0 DTE options. These are options that expire today. That's right, today. There's no wiggle room. So if you're right, you got to be right today. If you're wrong, well, you're going to be wrong pretty quick, right? They expire today. You have weekly options that, well, as they imply, they expire every week. They are listed Monday, Wednesdays, and Fridays. Some underlines list Monday right till Friday. So it all just depends on the underlying you're trading. If the underlying has options listed on it and it's not a big options market for it, typically you have just the standard monthly options that are listed, which is just every third Friday of the month. You also have end of month options. These are options that are listed on the last business day of each month. You have your quarterly option expiration, which are listed on the months of March, March, June, September, and December, right? Your quarterly months. You also have LEAPs. This stands for long-term equity anticipation securities, which just means they are options that expire. Let's call it a year. I know it's technically not a year, but anyways, options that expire 1 year or greater, or even 2 or 3, these are referred to LEAP options. You also have AM and PM settled options. Many cash settled index products are AM settled, whereas most equity or ETF options and weekly index options are PM settled. Let's break it down a little bit. If you're trading AM settled options, such as maybe monthly SPX, aka S&P 500 index options, the final settlement used will be based on the opening price of the underlying. And these options will trade until the end of the day before the expiration date. So a monthly SPX index option, they expire on the third Friday, but the last trading day is always the business day before, which is the Thursday, unless otherwise noted. And then you have the PM settlement option. So final settlement really just uses the closing price based on let's call it today. Let's say we have options expired today based on 4 o'clock Eastern Standard Time. The closing price of the underlying will determine if your options are in, at, or out of the money. In regards to trading hours, similar to equities, between the hours of 9:30 and 4 o'clock Eastern Standard Time, single stock options or equity options, such as maybe like a Royal Bank, a TD, an NVIDIA, or a strategy, these options only trade until 4 o'clock Eastern Standard Time. No and, ifs, or buts. 4 o'clock, hard deadline, that's it. There are options that trade an additional 15 minutes after 4 o'clock, and these would apply to index options and most ETF options that are based on indexes, such as maybe the SPY, the Qs, right? QQQ, IWM, to name a few. So always just double check and understand the products you're trading, right? So it's not an excuse to not know what you're doing. Always double check the contract specifications of any products you're trading. Moneyness. What does it mean? Well, all it means is where does the underlying price sit relative to your option strike price? In the case of a call option, your call options are in the money, or ITM, if the underlying price is greater than your strike price. Your call options are at the money, ATM, if the underlying price is equal to your strike price. And your call options are out of the money, OTM, if the underlying price is less than your strike price. The same is true for put options. It's just the opposite. Your put options are in the money, ITM, if the underlying price is less than your strike price. Your put options are at the money if the underlying price is equal to your strike price. And your put options are out of the money, OTM, if the underlying price is greater than your strike price. They're out of the money, OTM. Let's look at intrinsic versus extrinsic value. So there's really only two components of a option premium. You have the intrinsic value component as well as an extrinsic value component. This is also known as time value. The intrinsic value component, to work that out, a call option to determine if there's any intrinsic value, we simply just take the underlying price less the strike price. An example, if we have the underlying trading at $60 and we're long a $50 call option, well, that difference is $10. So theoretically, these options should be traded for at least $10 of intrinsic value. For put options, to determine the intrinsic value, we just take the strike price less the underlying price. Example, if the strike price is $50 and the underlying is trading at $60, well, it has zero intrinsic value. That leads me to our next component, which is the extrinsic or time value component, which is just a portion of the value beyond the intrinsic value. Various factors influence extrinsic value, such as time remaining until the expiration, implied volatility, interest rates, dividends, and ultimately supply and demand dynamics. Let's take a closer look buying calls or going long calls as an option buyer. So you now know buying a call option or going long a call gives you the right to buy the underlying asset at the strike price. It's exercisable by the expiration in case of American style option, or at expiration date if it's a European style. Your market view is bullish, right? You need the price of the underlying above your strike price to break even by the expiration date. In terms of your cost or your max loss, well, it's just a premium paid, right? It's a debit. It's no further obligation required. To determine your break even at expire, you simply just take the strike price plus the premium. And if you want to factor in your commission and transaction costs, that'll give you your break even as well. Your profit potential, well, theoretically, is unlimited, right? If you go long a call, the underlying you're trading could go to $1 million per share or even higher. Who knows, right? But your profit potential is unlimited. Your max risk is always capped at the premium paid. Let's take a look at a long call example. XYZ company, current stock price is $50 per share. And we have a target price of $60 based on our analysis. We think this can happen within 60 days from today. So what we're going to do is we can just buy to open one $60 call option expiring 60 days from now. Let's assume that it costs us $200 per contract. How do we get that? Well, if we're buying one contract and one contract represents 100 shares, we multiply by the premium, which gives us $200 per contract. Let's take a look at some scenarios that can happen. So if you're a long call buyer, let's assume XYZ company is trading at $65 on expiration date. Our option value would be determined by taking the $65. We'll take 65 less our strike price times 100. That gives us $500. Right. To determine our net P&L, well, if our options are worth $500, how much did we originally pay for them, right? We paid $200 or a $2 debit. Our net profit, excluding any transaction or commissions, it's $300 or $3 per contract. That gives us 150% ROI. It's not too bad, right? All right, I got some homework for you. Let's assume no commission or any transaction costs or fees. Should we exercise our options or just sell the close? Why or why not? What are some other factors you might want to consider if your options are in the money on expiration day? Let me know. Drop a comment below. Scenario 2. As a long call buyer. Assuming if XYZ company is less than or equal at $60 expiration, well, our options just expire worthless. And we realize our max loss, which is $200, right? $2 debit that we originally paid for the option contracts. So our loss is 100% of our investment. Let's take a look at a live options chain here. I have my Moomoo platform pulled up here, and we can see I have Netflix up, currently trading at $93.21 and change. It's down $1.17 or 1.2% for today. And pretty standard. If you go into any options chain here, typically they have some tab or button you can click to get to the options chain. And it would look something like this here. On the left side, these are always call options. And on the right side, these are put options here. With Moomoo, it does allow you to look at both call options and put options. Or if you just want to look at call options, you can do that, or put options. That allows you to do that as well. And then you can further refine here if you want to look at options that are both in the money or out of the money. You have that as well. And most option chains will have some type of contrast to easily visual identify whether an option is in, at, or out of the money. Not sure if it's too clear on my screen based on the colors I have, but I can see that this side here for my call options, the background is kind of gray. This tells me these are in the money call options. And then for the out of the money call options, the background is black. This is built into Moomoo as well here. Let's explore the option chain a little more here, very high level. Again, this is not a deep dive for the Moomoo platform. I'll have a separate video specifically for this platform here. But again, any platform will have default metrics here. So with this here, we can see that pretty standard metrics: volume, got put call ratio, open interest, some implied vol, historical vol, something called IV rank, as well as IV percentile, to name a few. And then we have a few other options that I described earlier. These are some Moomoo features here, such as looking at the curve, option strategies, as well as selecting the strikes and the expirations. And then in terms of columns, no different than equities, right? We got the bid and ask. We have mid, ask price, last price of the option, the change, the volume of contracts traded today, open interest, and then I have the intrinsic and extrinsic value on my columns here, as well as the Greeks, which we'll take a look at later. Let's take a look at just the call options here. Keep things a little simple here. And on the left side here, you can see that there are multiple expirations I can choose from. The closest expiration I have here is for December 26th, which is in 4 days. So Merry Christmas, Happy Hanukkah, Happy Holidays, whatever you're celebrating. We're close to the end of the year here, but you can see these options expire in 4 days. We have a January 2nd options that expire 11 days. And then we have a monthly standard options, which is January 16, 2026, which expires in 25 days. And let's say we're bullish on Netflix, and we'll use, in our example, we did it 60 days. So we can look at a February 2026 60-day option. And let's just expand that. And let's assume that we were bullish on a Netflix. And right now, Netflix is currently trading at 93.20. And based on our analysis, let's say we think it can trade to, I don't know, let's say $110 per share by February 2026. So what I can do is I can just click on the ask price here, which is $1.23. And this will automatically create a buy order for me in the Moomoo platform. So it created our order ticket for us. So we can see that we have the February 2026 expiration selected. We have the 110 strike. These are our call options. We're buying these options, and we're buying a one contract. And no different from equity, we can select our different order type. So whether market limit, maybe, I don't know, stop limit, but let's just go with limit here. Our time in force for the order, we're just using a strictly day order. And I'm just going to lock my price into the mid price, which currently is trading at $1.20 per contract. And we can see here, Moomoo gives us our POP, which if we click here, that is the probability of profit, which estimates the likelihood that an options trade will be profitable at expiration based on the current implied volatility, which is 12%. But what I wanted to focus on here is that it breaks down our max profit, which we know if we are long a call, it's unlimited. Our max loss, excluding commission, is $120, right? So if we have a limit price to buy at $1.20, if Netflix doesn't trade at 110 or higher, well, the most we can lose is $120. Our break even, it's $111.20. Well, how do we get that? Well, if we take our strike price of 110 plus $1.20 debit that we're trying to buy it for, this gives us our break even of 111.20. It also provides us the Greeks, and we will touch up on that when we look at the Greeks in the next slide here. But Moomoo also gives us the Greeks here that we'll take a look at. So if you're okay with that order, all you would do is just send off the order here. So again, in my platform, I could just click unlock trade, fire off the order, and we're good to go here. Continuing on, let's take a look at an example as a long put buyer. So as you know, buying a put gives you the right to sell the underlying asset at the strike price, exercisable by the expiration date in the case of an American style option, or on the expiration date in the case of a European style option. Your market view, either bearish or maybe you're hedging, so you're expecting a decline in price, or maybe you want some downside protection on an existing position you already hold. Your cost or max loss, again, it's just a premium paid, right? It's a debit, no further obligation required. In terms of your break even at expiry, well, it's just the strike price less your premium that will determine your break even. And in terms of your profit potential, well, technically it's limited, right? Because the stock can't go below zero. So it's limited by the strike price less your premium is your profit potential. Looking at our first example as a long put buyer, let's assume UVX company currently trading at $50 per share. And we have a target price of $40, and we think this can happen within a 60-day time frame. So no different. We're going to buy or buy to open one contract of a $40 put expiring 60 days from today. It's going to cost us $200 per contract, or again, one contract is equal to 100 shares times the premium. That's how we got the $200. Looking at some scenarios. So if UVXY company is trading at $35 on expiration day, our option value should be $40 less 35 times 100 gives us 500. To determine our P&L, well, if our options are worth $500, we paid an original debit of $200. Well, our net profit, excluding any commission or transaction costs, is $300 worth $3 per share. And that's 150% ROI. Not too shabby. Got some more homework for you. Again, assuming no commission or transaction costs or fees, should we exercise our option or just sell to close? Why or why not? What are some other factors you might want to consider if your options are in the money on expiration day? Let me know. Drop your comments below. Looking at scenario 2 as a long put buyer, assuming if UVX company is greater or equal to $40 on expiration, well, our options just expire worthless, right? And our profit and loss would be negative 200, or our max loss was the debit or premium paid in this case, or 100% of our investment. Let's take a look at a real world example of buying a put option using my Moomoo platform here. Let's get bearish on something. Maybe we'll get bearish on here. How about NVIDIA? And I'm going to go to the options chain. And again, by default, you should see something like this, where again, you see both calls and put options. For the sake of this demonstration, I'm just going to look at just puts themselves. And we can see here, NVIDIA currently trading at 183 and change, up to 44 for the day, or 1.3%. I have the option chain selected. And let's go through this here. Okay, so if I'm bearish or maybe I want some downside protection on an existing position, let's go out 60 days from here. So we can see here, I'm going to select 60 days option. Going to take that. And let's say, you know what? Hey, I think NVIDIA, if it goes down to $100 or lower, I want some protection on here. And we can see that the price right now, if I buy one $100 put option, is 13 cents a contract. Let's go ahead and get that buy order created. We can see here, expiration date, February 2026, or 60 days from now. These options will expire. We're going with the $100 strikes. Put options, we're buying one contract. Based on that, if we're okay with that, we can go with a limit order. We'll use the mid price. So in other words, this is going to cost us approximately $13 per contract. And just looking at Moomoo here, it breaks down this all for us. So again, our max profit, well, our POP, 0.01%. Max profit, let's just call that 10 grand. Our max loss is $12 per contract. Our break even, 99.88, assuming we hold to expiration. And then we have our Greeks here, which I will cover in our next slide here. And if I was okay with that order, I can just go ahead and actually fire that order off here. And I would just click on this here and good to go. I also wanted to show you also the impact of the option premium based on the moneyness, right? Whether it's in, at, or out of the money. Since I still have NVIDIA up here, let's look at the call options. And let's go, how about we'll look at a January expiration here. January 30th, 2026 expiration, which is about 39 days from now. And we can see that the further in the money the call options are, the greater the premium, right? So the ask price here, they're asking $136.30 per option contract, because theoretically they should be trading for at least their intrinsic value, and any additional amount over that will be extrinsic value. And that's why I like to have my little columns here. You can see intrinsic, $130.45. Extrinsic, well, there's no time value on this here. But if we start going closer to something like at the money for the call options, well, I'm just going to clear this here. So again, NVIDIA trading at around 183. If we go to an at the money option, we can see that, well, this is slightly in the money. Actually, it is in the money. It's 183. These are the 180 calls. Let's look at the 185 calls. These are the closest to being at the money. And we can see that they're asking $8, right? So these are out of the money. They're slightly cheaper. And this is all time value. And if you want to go further out of the money, right? If we want to go further out of the money, let's say we look at a $300, a $300 call option here. We can see that they're only asking 2 cents. So the likelihood of NVIDIA going to 300 within 9 days, very, very low odds. Whereas when we looked at something kind of like at the money here, we can see that, okay, the odds of NVIDIA going to 185 in approximately 40 days, highly more likely, or I should say more probable, but you're going to pay $8 for that. And if you want more certainty, or if you buy a deep in the money option, such as the $50 calls, you got to pay a lot higher for a premium because, again, this has intrinsic value, right? So I hope that this clears up how moneyness will affect the option premium, whether you're buying in, at, or out of the money, but that will ultimately determine the overall price you pay for the option, right? Last but not least, let's take a look at the Greeks, very high level. And essentially, this is what will move your option premiums from day to day based on these parameters, aka the Greeks. So you have delta, which really measures the direction for every $1 price change in the underlying asset. It provides insight into the contract's directional risk. You have gamma, which measures the rate of change or the delta speed. And this indicates how quickly directional exposure can accelerate or decelerate. You have theta, which is also known as time decay. And this helps evaluate the impact of the option's time decay. And again, this is represented through the passage of time. And then we have Vega, which measures option sensitivity for changes in implied volatility for every 1% move up or down. And again, it helps assess how volatility shifts affects your option contract prices. And then we got Rho, which will move based on the changes in interest rates, or I should say, measures the sensitivity of the options contract value to changes in interest rates per 1% change, right? This is more pronounced on long dated in the money options, but again, so something just to be aware. All right. If you found this helpful, make sure you hit the like, subscribe, and drop a comment telling me why you're getting into options or what are you trying to learn. I'm Peter Penn. I'll see you in the next one. Ciao.